Happy Friday, Eric Bibel with the Bible team at Neil Home Loans, where it's been a rough couple weeks. We finally got some good news for both mortgage rates and the ongoing saga around the National Association of Realtors Commission lawsuit, which we'll dive into here at the conclusion of this video. But first, let's understand what's happening with rates, what victories we took this week, and ultimately where the market is sitting currently. So as we kick off Friday morning, 30-year fix is sitting at 7.43%. You might be saying, Eric, that's up from last week's 7.37. Why are you celebrating? Well, earlier this week, Tuesday, Wednesday, really into Thursday as well, 30-year fix was over 7.5%, and it was marching higher. So the fact that we were able to retrace and ultimately be pretty much flat from where we were last week, we'll take that as a victory. And the question ultimately continues is, why have rates moved in this manner, and what can we expect going forward? As my update outlines, really it's centered around a readjustment. The prevailing narrative was the Fed was going to cut rates as inflation declined or unemployment moved higher. Those two things have not happened. And it's looking like that first assumed rate cut in June is now being pushed out further. So the market is adjusting to this new reality, new expectation. And in turn, we're going to see volatility within mortgage rates. Now, the question becomes, how can we use this volatility to our advantage? And it's really around our buyers as well as our sellers. As families make decisions to elect out of the buying process due to an increase in payment, higher rates, whatever that reason is, it gives opportunity to the buyers that have been beat out before, that are willing and able to weather through this moment. As we saw the buyers purchase in October of 2023, when rates were higher than this, remember they were over 8%. Those clients got an opportunity to refinance earlier this year because rates came down as we expected. We expect the same to be true at some point in the not so distant future. The buyers that take action now will have an opportunity when rates correct. So really, this is the message that we need to continue to drive, is that inventory is finite. We know that. Yes, listings have increased, but not at the levels that we need. Rates will come down. I don't know when. I don't want to say, I don't want to put a date next to it, but at some point they will, as we saw earlier this year, and you will be in a position to restructure that debt. So again, let's continue to get that message out and empower our buyers to make informed decisions. If you need help with this, as always, we're here to support you. Next big piece, Monday, Fannie Mae, Freddie Mac, government-sponsored enterprises finally released clarification around how credits from the seller, specifically around commissions, will impact what is called interested party contribution. So, quick breakdown as to what IPC, interested party contributions, are: credits from the seller to the buyer. When financing is involved from FHA, VA, USDA, conventional, jumbo, there is a threshold of how much credit a buyer can receive as an investment property, regardless of how much you're putting down. 2% across the board. Max they can get back is 2%. 10% down, 3% from the seller. That's conventional financing. Over 10%, below 25%, that goes up to 6%, so on and so forth. I've included a cheat sheet below as well. The concern walking into this is, hey, if the seller or the buyer has to pay my closing costs, but has gotten a credit from the seller, so they've increased the price, the seller's crediting back, but also crediting for, say, closing costs, repairs, whatever it may be, and we start exceeding these thresholds, what happens to those dollars? They get lost, or you have to do a price reduction. So with Fannie Mae and Freddie Mac coming out earlier this week, seller credits for commissions as a normal practice will not count towards interested party contribution. Huge victory, basically the same as we are today. So for simplicity, let's say you're buying a $500,000 home. Client's putting 3% down. Their max concession prior to this update from or assuming we go into July, I should say, they're putting down 3%. So they can get 3% back from the seller. But they also need to pay for the commissions, but we're asking for credits for closing costs. Well, 3% was all that the seller can give. So if the cost exceeded 3%, the buyer would have to come in with that difference. With this direction from Fannie Mae and Freddie Mac, if you're getting, let's say it's 3% or 2%, whatever that number is from the seller for commissions, but an additional 3% for closing costs, the 2% or the number over here allocated for commissions does not impact the closing cost credit concession. So yes, it's essentially the same as we're experiencing now, but it provides further clarity on what we can expect should the NAR settlement become reality later this year. I've also, as I mentioned earlier, included a cheat sheet on seller concessions in the body of this. If you have questions on it, know that we're here. We want to support you. As I've advocated over the last few weeks, as this has become the new talking point, it's all about value. Those who demonstrate the most value can command the highest price. If you need help articulating your value, we've experienced this for many years in the mortgage business. We have wonderful scripts, tools, basically a menu of options that we provide our clients to demonstrate our value. We'd love the opportunity to connect and help. As always, make it a fantastic Friday and an even greater weekend. Thank you.